Good morning. We're just allowing a few more attendees to join, but we'll make a soft start. My name is Mark Spence. I'm Managing Director of Construction Employers Federation. You're very welcome to this morning's webinar by our patrons, Willis, Towers, Watson. We are going to use a webinar on Zoom this morning, which you may be familiar with and you may not be, but the way we will run this is we'll have a presentation from our two guest speakers from Willis, Towers, Watson this morning, during the course of which I would ask you, if you go down to the bottom of the screen, you'll see a Q&A icon. And I'd ask you if you have any questions to use the Q&A, and I will pick up those questions on your behalf at the end of the presentations and pose them for you. You can do that anonymously if you wish. So we'll use that function, and just for your information, this session is being recorded. If that's a problem for you, now is maybe the time to leave. Hopefully that's not a problem. So with no further ado, I will be thanking Willis, Towers, Watson for hosting us this morning. We have Trevor McClintock and Andy Petherbridge, who are going to take us through two different sessions. One giving you some hints and tips on how to renew your insurance and get the best value in this difficult market. And Andy will also then be looking at surety and bonds, which is quite an issue in the construction market as well. So as I say, I will pass you over now to the safe hands of Trevor, who will take us through the first part of his presentation. Thank you, Trevor.
Thanks, Mark, for that introduction, and good morning to all attendees. Welcome to our webinar, and as Mark has said, we plan to cover the whole area of preparation for a insurance renewal in the midst of a hard market. And then Andy will follow with some insights into bonding and surety. So I hope everyone can see the slides, and we'll proceed from here. So again, just in relation to my section of the presentation this morning, we're going to have a look at what state the insurance market is in. We're going to look at the Ogden rate, which may be a subject that is familiar to you, certainly been in the news in recent months. Professional indemnity, of course, has been a difficult and challenging area, and we'll review that. And then have a look at what you should do, and basically early planning and action and preparation. So, looking at the insurance market as we stand in May 2021, when we look back over the last 18 months or so, the conditions have deteriorated. And it's fair to say that this trend really predates the COVID-19 pandemic. I don't believe really COVID-19 should come into this narrative at all as far as its effect on insurance hardening of the market. So the impact of the market is such that it's not merely price increases that we're seeing. Perhaps of greater consequence than simply price increases is the fact that there is reducing insurer appetite. And within certain trades, it's actually difficult to obtain the level of cover that might be required at any price. Now that is obviously extreme situations, but if it is a heavy trade, that can be a reality. There are a number of insurers who have exited the market, coming to the assessment that there was little opportunity for profit. The deterioration in the market is frequently evidenced by insurers reducing their capacity, most notably on property renewals, and on occasion they reduce their participation, which then requires additional support from several insurers to provide the cover which might previously have been provided by one carrier only. And so this in turn drives further price increases and possibly additional cover restrictions. Professional indemnity insurance has perhaps suffered most, and we'll look at that separately. Property insurance is now experiencing severe capacity reduction and price increases, with insurers being selective as to what risks they want to participate in. So loss-making market conditions are a reality in an era when investment return has really declined significantly. You find that insurers are more sophisticated in their underwriting, with, for example, flood mapping being used. So they're seeking to protect their account by avoidance of accepting flood risks where they see flood as a likely occurrence. And when cover is accepted in what insurers do consider a flood risk area, terms quoted are often subject to major deductibles and other restrictions in cover. You may find when it comes to contract works, for example, and large project policies, that the likes of high-rise properties are not being favoured by insurers and are subject to perhaps an insurer reducing capacity, maybe taking a lead line of 50%, and therefore you require support from a second insurer in order to provide the capacity you need and the full 100% cover. So moving on then to the whole area of the Ogden discount rate. Now this is something that has, as I say, featured recently. The Ogden discount rate, just in summary, is used by courts in the calculation of compensation in personal injury cases. So compensation awards are designed to put a claimant, particularly here we're thinking of someone who's been seriously injured, back in the same financial position they would have been in prior to injury. So the award will take into account future losses, and it will also take into account the likes of long-term care costs. It's designed to ensure that claimants are not, on the one hand, overcompensated or undercompensated. So in order to achieve this, the courts apply what's referred to as the discount rate. And this adjusts the personal injury damage award to take into account the return expected over time when that compensation lump sum is invested. So in March this year, the Department of Justice announced it will change the personal injury discount rate from plus 2.5% to minus 1.75%. And now the department does intend to bring forward secondary legislation in order to implement the change, and anticipates that the new rate will come into effect 31 May this year. But this is an interim rate, and the idea is that there will be a more stable long-term rate by early 2022. Now, what is the impact of this? Well, the change in rate will significantly increase settlement payments made in serious personal injury claims, where there are loss of earnings and where there is perhaps whole of life long-term care, and in some cases by multiples. Some solicitors have worked out sort of hypothetical examples, and one of them gave an example of a 10-year-old sustaining injuries requiring annual care costs of 100,000. And for the purpose of calculation, based on the current discount rate, that award for that 10-year-old left needing long-term care, the award would likely be in and around 3.4 million or thereabouts. Under the changes proposed and indeed coming into place, the award would move from in the region of 3.4 million to closer to 17.7 million. So that is a startling uplift, and I have to say that's the Northern Ireland Ogden adjustment rate, and it is out of sync with the rest of the UK and indeed Ireland by way of the likely awards going forward. So this is going to clearly affect the balance sheets of insurers, and it will affect rating on employers' public liability, for example. It also will have implications that moving forward, you will see a drive for higher limits of indemnity. I would fully imagine the like of bodies that would have sought, say, a minimum of 10 million for public and or employers' liability will be nudging that forward to maybe 20 million in the future. So that has significant impact. Professional indemnity, again, has suffered significantly, and I imagine contractors that are on the call this morning will have experienced significant uplifts, perhaps over the last 2 renewals in their professional indemnity, their design and construct renewal. So reduction in capacity continues, and securing support for significant limits of indemnity is difficult. That is challenging. Rating is still moving north. 50% has been still sort of muted as being typical in the market, although I do believe we're beginning to see some measure of stability. Coverage, again, that has been an issue, with the any one claim basis of cover being very difficult to secure, and the aggregate limit more prevalent, with round-the-clock reinstatements sometimes required to achieve a higher vertical limit of cover. And again, higher deductibles normal. Insurers restricting the scope of cover from fire safety limitations being standard. We could well be moving to fire safety exclusions being standard. So insurers are focused on understanding the supply chain of contractors. They're focused on subcontractors and other third parties and the level of cover that they might have. So a very difficult area. What do you do in the midst of all this? Well, really the key thing is you've got to act early as far as insurance renewal is concerned, and allow a good 3-month lead-in time. Much shorter lead-in times would have been acceptable in soft market conditions to achieve a good renewal result. Unfortunately, you've got to move early. A lot of insurers are inundated with presentations for new business, and therefore their focus will be on renewing their existing book. Quality of information, detail. And I've set out in here a lot of things that may be requested, not necessarily for renewal, but for example, if underwriters are considering a sizable project policy, project contract works policy, they're going to be looking for things like, how are you managing water? They're thinking in terms of the flood risk. They're looking at methodology in more detail, plans, lots of breakdown as far as the contract value is concerned, so that they have a much better understanding of the risk. So detail and good quality information is something that is normal now. And yeah, it involves more work for you as the insured in order to provide that. So that's all very good. You move early in the process. You prepare the information, and again, you'll be familiar with perhaps additional pro formas and so on that need completed for the renewal process. Then it's a matter for the broker to really engage in a robust marketing exercise on your behalf. Previously, you might have expected insurers to provide answers within a reasonably short space of time, maybe a week to 10 days following the presentation from your broker. But now we're seeing that time frame extended by quite a bit before insurers may be coming back with additional questions and looking for additional information within the time frame before ever you get to the stage of producing quotations. So a challenging market, and you know, quotations that insurers provide are now usually subject to a maximum of 30 days as far as they're being valid is concerned. So it's all about the timing. With a hardening market, if a quote is not taken up within that time, they reserve their right to perhaps change or withdraw the terms offered. So in addition, whilst there is still a good level of capacity available to underwrite even the sizable risks and large contract works projects, there are fewer lead insurers looking to provide terms, and many are looking to see what others offer before seeking to offer support. And again, they won't necessarily follow the terms offered by the primary insurer, and may look to have their own conditions and different rating even. So really, if we're looking at what is the key message as far as preparing for your renewal and preparing even in advance of presenting project-specific risks to the insurance market. The key thing is to get moving early and allow plenty of time, well in advance of renewal date, well in advance of the date when cover needs to be incepted. And also the key message, further message, is that be prepared for requests for substantial amounts of detailed information and good quality information. Be prepared for a fairly long response period from insurers. And so by doing all that and being prepared, it puts you in the best position to get the best available coverage and at the best available terms. So act early, and good quality information is key. So at this point, I'll hand over to my colleague Andy Petherbridge here to continue with surety and bonding.
Thank you very much, Trevor. I'll be about 20 minutes, guys, so just go to the next slide. I'm just going to cover off the basics of surety. I know I'm preaching to the converted, but sometimes it's useful to go back and just look, the construct, and just remind yourselves of that to understand what the underwriters look at. It's important when you're presenting your requirement to them that you understand what they're looking at, and it helps us shape that and influence them. And then the surety market, what's going on? Is there, the availability of underwriters, their capacity, the average cost, that kind of thing. And then we'll talk about our best foot forward, how we can assist you in doing that, and then managing your facilities ongoing. So how surety works, you just click through all of that, Trevor. Sorry, thanks. Basically, it's a tripartite arrangement. Unlike in surety, you have the insurance company and yourself. In bonding, which is not an insurance contract, it's a guarantee. It's a piece of paper that basically makes a promise to another party. So you are the principal, other terms, obligor and contractor, and you have a basic contract with the employer, and the bond sits beside that. And usually the terms of the bond are specified in the contract. So basically that's going on, and the employer wants a bond from you to confirm that you'll perform the contract. That's it in a nutshell. It's all down to trust. Bonding originated somewhere around 2000 BC. It predates insurance, and it's all down to the fact that human beings don't trust each other. That's what it is. In addition, there's a due diligence element to it too. So the bond is basically, again, if you click a little bit more there, Trevor, I'm sorry. The bond is provided by the surety company to the employer. You see that arrow there, and then the right of indemnity. Every bond is collateralized. So there's a right of indemnity from the surety company to yourself, to the principal, and that's basically the bond will be paid to the employer subject to certain conditions, and then the surety comes looking at it from you. If God forbid the principal is gone bust, well then the surety takes a hit. And most surety companies work on a zero loss ratio. listening to Trevor's presentation, I fully understand, and I was in that market for years, loss ratios, managing losses, etc. Surety, they do not expect to have losses. They do, and when they do have them, they're usually pretty big. So that's pretty much the way it works. It's a guarantee. So, next slide, if you don't mind. Thanks, Trevor. So, what are the key criteria? It's the 3 C's. It's your character, it's your capital, and it's your capacity. So on the basis that the employer wants the bond, the surety wants to know you can perform the contract. So these are the 3 key things. Have you got the reputation, the integrity, the track record, your previous contracts, the previous bonds, were they released on time? All of those things are relevant. Your capital, and this is where the big game is. Are you using your working capital properly? If you bond through a bank, you're wrapping up that amount of the bond value as working capital. If you do it as a surety or a bond with a surety company, the surety company is writing the bond on the strength of your financials. So you're not wrapping up that bond value. That's a really important point. And if you do have a balance, or you do most of your bonds through the bank, you need to think about this. And usually we can match or go better than the bank rate. So instead of paying money to use your own money effectively, you're getting a surety to take the risk. And the capacity then, have you got the capacity? And we just had an interesting conversation while we were waiting to go on the call, Mark, myself, and Trevor, about the pressures now in the industry. There's always pressure, but it seems unfair right now what's going on with post-Brexit, COVID, and general economic conditions. There's a shortage of supply of materials, timber, steel, etc. Because the US and China have bought up most of the supplies, as we know, and that's putting pressure on. And then labor. So the underwriters will want to know you've got the ability to perform the contract within the time specified. Next slide. Thanks, Trevor. So just to give you a very brief, we've 11,000 bond wordings in our system that we've negotiated with underwriters globally. But essentially, there's 2 types of bonds: contract bonds and commercial bonds. I won't go into commercial at all. They're of no interest to you today. They're revenue bonds, judicial bonds, that kind of thing. But you can bond almost anything. I'm involved in a bond at the moment for it's securing a payment on a large contract for 50 million. So I do bonds from 2,000 bond value to large value. It doesn't matter. A bond is a bond, and that's what I always say. The most of the bonds you come across are going to be performance bonds, as I've highlighted there. Bid tender bonds don't tend to happen on this side of the Atlantic. They're very big in the US, and the other difference between us and the US, they have 100% bond value on the contract, as opposed to 10, 12.5, 15% here. So the cost of bonding in the US is considerably higher. The other bonds you might come across: advanced payment bonds, warranty and maintenance, and environmental bonds. So that's really the arena that construction is in, and obviously these are familiar to you. Next slide, thanks. So the key metrics in understanding underwriting, I've summarized them down below, but part of our job is to get you presented to the market in the right way. So we'll talk to all of the underwriters, and I'll show you who's in the market and everything else. And it's really important that we present your numbers and your financial strength in the right way. If you're weak financially, you're going to have a problem getting bonded. There's just, you may have to go back to the bank and get a bank guarantee or whatever, and then put up cash. So it's really important that your business is reasonably well capitalized. And this is what they look at. They look at working capital, they look at net worth and your debt to net worth ratios. These are your own financial guys will advise you, but it's useful to see this, because you can see, a surety underwriter is very like a bank underwriter. They're going to want to know how you're doing here. So your annual audited accounts are important. I know there's been delays on those allowed recently, but the underwriters will want to see them. They want to see your draft accounts or your management accounts. And it's very important that you share those in the right way with the underwriters, and they're presented in the right way. Next slide. Thanks, Trevor. So again, I just thought it was useful. I won't spend much time on this, but this is the way underwriters, this is what they have in front of them. They have a list and this is what they go through. So when you apply for a bond, it takes a while to get terms back because there's a bit of analysis involved. And you know, one common theme between my presentation and Trevor's is time. Get in early, get your information presented in the right way, have it locked and loaded and ready to go. Next slide, thanks. So this is the market as it stands, and some of you may be surprised to see so many names up here because I can remember not so long ago, maybe 3, 4, or 5 years ago, when there was only a couple of players. There was what I call the dark market, a lot of underwriters that wouldn't be approved by us. That's not such a big thing, but we have a certain standard, certain grade of underwriter we deal with. And these are the ones that are currently approved by us. Some of those names will be familiar to you, some may not. Some of them are more global than local, but there's good, healthy competition in the market. The capacity is very good. And really, if you're a strong entity, relatively strong, you've got good cash flow and you're well organized, you should be able to get terms from the market and get reasonable terms too. The ones that we would deal with mostly for SME type clients would be the likes of Tokyo Marine, HCC, you'll see in the middle there. Nexus and Great American have got together. Advent is an underwriter down south, but they specialize a lot in development bonds and the like. But they're a good player. And you have Aviva still active, although not easy to deal with. Euler Hermes are very selective, but they'll quote. Markel are a bit niche, but an interesting underwriter. QBE would always be up to quote. And Credendo have increased their resources in Ireland and Northern Ireland in the last 6 months. So that's the market. It's pretty good. There are others out there, but those are the ones that we deal with and the ones we can stand by. Next slide, thanks. So I just thought it'd be useful to give you a sense of what's going on in the market right now during the virus. What's the temperature of the market, so to speak? In terms of premiums, nothing has really changed there. The rates are, depending on your financial strength, the lower the rate. It's pretty much it. It's cost of capital. So, you know, average rates sort of 1 to 2%, that kind of line. If you don't have many bonds and you're a small entity, you'll probably see 3 to 5%, that kind of rate. It could be a flat rate or it could be a per annum rate. Again, you just need to get it out there, get out with maybe 3 key underwriters for your type of company. And just, I would concur again with Trevor's view, getting the attention of underwriters to respond is the challenge. And we've got a large book of bond business, so we've quite a bit of leverage. We usually get responses fairly quickly. The coverage is again fairly steady. The bond wordings are usually agreed. If there's items in there that are not easy, it's negotiable. That's what the underwriters do. They have good relationships with the local authorities and with the larger employers. So, you know, that is a key part here. Getting the bond wording over the line is important, and protecting your interests too. You don't want an onerous bond wording. So the conditions around it need to be copper fastened from your point of view. The collateral is usually a deed of indemnity. It's a simple 2-page document that says if the surety comes looking for the value of the bond, that you will pay up. That's it. Again, standard stuff, nothing too onerous. There are most bonds we deal with are conditional bonds. So breach of contract, you weren't able to perform the contract for whatever reason, they're not usually on demand, but we do have access to on-demand bonding, particularly on larger stuff, with some of the energy companies, for example, where the bond values are in, 5 to 50 million. Obviously there is, but you'll hear that term on demand. It's not on demand. There's usually conditions around performance bonds. The variables right now, certainly COVID-19, the variant effects. We look like we're all on the right road now, which is fantastic. Can't wait to get my hair cut. Lucky guys up the north, but look, things are getting better. There's an optimism there, but a cautious optimism is the way I'd describe it. Brexit has not gone away. It is still an issue, particularly not so much on construction bonds, but certainly on revenue bonds. So I won't harp on too much about that. That word, I'm sure, is ingrained in all our brains. And then the global economic recovery. How will we recover? How quickly, gradual or otherwise? There's lots of things out there, and then there will always be things in that box that we have to deal with. That's just the nature of business. But I think the resilience of construction has been fantastic. A little bit more difficult down here for sure. If any of you have interest down here in the south, but look, the health and safety experience of the construction industry has certainly come through, and the confidence is there certainly from underwriters to maintain capacity. As I said, the competition and capacity from underwriters is there. There's good competition, so if you're finding any difficulty, just let us know. We'll certainly help you out. Bonds in general provide flexibility. In terms of bank bonds can take a while to organize. You don't want to use your cash, so it's quicker and there's more experience, I would say, with the surety underwriters. They usually come from construction background or whatever background the bond focuses on. The key is to optimize your working capital, and this is going to be so important for the next 18 months or so. Just getting the businesses back to where they were and beyond, that is something that we can assist you with, in presenting you in the right way to the market. There are alternative solutions for more complex bonds, particularly in larger deals. We've had to get involved in negotiating credit ratings and things like that. So we have experience on that too. It's all about trust between the employer and your good selves and getting the job done. And what they really want is a second pair of eyes to say, you've been put through due diligence. These guys are good to perform the contract. That's basically the purpose of it. And a lot of people say to me, I get frustrated comments. Why do we need a bond? It's not a waste of money. Maybe, but it's part of the cost of the contract overall. The employer usually pays it indirectly or directly. I think to have your bond facility locked and loaded in advance, particularly at tender stage, is very useful, because a lot of contractors don't. So it might give you a market edge. And project completion, for the employer, it gives them more confidence around project completion. So, but the market is generally good. Next slide. Thanks, Trevor. So this is kind of the last part, bond execution and management. I just thought it was useful to give you a sense of what's on my desk. This is when I open up a file, this is what's on the template on the inside, right? It's basically, that's all the information I need. With a basic application form. We need your WIP schedule. How many jobs have you got at the moment? What state are they at? We may need site plans, phasing. The underwriters may ask for that. I don't ask for that unless they ask. Obviously, your financials are crucial. Your annual audit accounts. They'll ask for management accounts for sure. Just a one-pager or two-pager from your accountants or your FD or whatever. Bond wording and bond requirements. Get that out there quickly. What is the bond wording? What value? Usually 12.5% is adequate. And then they may ask for what's called a general information or a bank information form. General information form completed by yourself if they don't know you or you haven't had a large bonding facility before. A bank information form from your bank, so they want to see what's in your accounts right now. So you can see it's fairly detailed and personal. So just to warn you on that, I'm sure most of you will be familiar anyway. Then I get to work once I get whatever amount of information I want, usually the application form, the WIP, and the financials, bond wording. I get into the market. I know the underwriters that would be suitable for the particular companies I'm dealing with. I start negotiation, and then I end up with a basic market report and recommendation to you. You may establish a relationship with one surety, or you could have several that have capacity that you need. I have one client at the moment that they need a 10 million capacity, which is quite high. And we have that with 4 different underwriters. And part of that is co-surety. So on the bigger bonds, we get 2 or 3 of these sureties to write the bond. It's very like co-insurance on the general side. So finalizing the business, the bond wording is get that approved, get it on the once we've selected the surety, get that on the surety's paper, get it approved, and finalize the deed of indemnity. That only needs to be done once at the start. That deed of indemnity will be good for all your bonds with that particular surety, and then get the instruction to execute, and we issue our terms or whatever, and then the premium needs to be paid up front. There may be a fee with some underwriters, usually very small. Not, I would negotiate that out most of the time, 500 to 1,000. It's just not necessary. So if you see that, just try and avoid that. Our income is derived by commission from the particular underwriter. So it's usually in the sphere of 10 to 20%. Happy to disclose that, but you'd pay the same premium. It's just they pay us for doing all of this work effectively and for looking after you. And then we issue the original bond and send the deed of indemnity to the surety. Very important. There's a great relief, I suppose, once the bond is done and you can get on and do what you're meant to do, which is building. But following up on the bond, during that release date forward and getting it released gives you, releases capacity for you for further bonds. So it's very important to keep tagging those, get your PC certs, get through the maintenance period. So it's very important to work with me, the broker, on that, and we track that. And it makes life easier. So the more work you do on that as you go, the better. So managing your bond facility and your capacity ongoing is really important. So just one more slide, I think there, Trevor. I just thought it was worth mentioning, we also do trade credit insurance, as you may know. We would be the largest player broker-wise in the north and in the south. And we have been asked for this over the last 6 months or so. So we provide a credit rating support service. So how you rated with the credit insurers, how you rated with the rating agencies. There's a process we can go through and help you with that. My colleagues, Jim Brown and Peter can assist you if that's necessary. And we, it's a small fee. It's not a huge amount of money, but it's important that you are rated correctly with the credit insurers and with the rating agencies. And remember, a lot of these bond providers are also credit insurers. So you can be sure they're using the same database. So it's just something to be cognizant of. I'm sure you've been asked sometimes by credit insurers for your numbers because your suppliers want credit insurance on you. So it's just something to bear in mind. I just thought I'd put it in there. It's something that we can help you with. So just one last slide, I think there. I've put in some information on what those bonds are, but I'm not going to go through that. So I suppose the key points overall are, get in early, same message as Trevor. Don't come with a week to go and say, get me a bond. Happy, customers are always right. I always say I can, but it's never that easy. It takes, particularly if you haven't had a regular bond traffic before. Those of you who have, again, it's just keep your facilities up to date and know where you're at and keep active and dialogue going with the underwriters. I always encourage direct dialogue with the underwriters. In our business, that's really important. Thanks very much.
Okay, thank you both. Trevor and Andy, those were great presentations, and I can see we have a number of questions here, but there seem to be a few on bonds. I'll give Andy a moment to catch his breath. Trevor, I wanted to ask you about PII. I don't know if you recall, about this time last year, it was just pre-COVID, you and I actually went to CPD in Hollywood.
Correct,
to discuss PII because it was obviously a mounting issue for construction and still is a huge issue. But I gather from your presentation, there's a sense that we're maybe at the worst point now, and there might be some settling in that market.
Yes, I'm hopeful that we are close to the, as it were, insurance runs in cycles. So there's peaks and troughs. And I'm hoping that we have reached the peak in professional indemnity. And whilst rates remain high, and whilst perhaps for some risks there will still be increases, I'm hopeful that the worst of the increases are behind us, but rates will remain high. One encouraging sign has been, and again, this is typical of the cycles in insurance, when rates reach what underwriters consider a profitable level, you find that there will be other insurers who will come in and start, albeit with tentative steps, offering additional capacity. And in the London market, we're finding that that is actually happening. There are new names appearing who are prepared to take at least a small amount of capacity. So a little light at the end of the tunnel.
Okay, well, hopefully, yes. And obviously, we're working with the government clients to make sure they don't overspecify their requirement as well. So
yeah,
maybe those two things will converge. Good news. Okay, then a question for you, Andy. Can you explain the difficulties that can arise over required surety wording? Some of them are very simple, some are more complex.
Yeah, sometimes, employers, the bigger guys are easier to deal with, to be honest with you, because they've standard wording, they've been through it, they know what sureties accept. But sometimes you get lawyers coming into the equation between us all on this call. So you just got to be careful in that regard. The underwriters are well experienced on this, and usually we negotiate them out or there's a compromise. So I would say, look, it's part of every bond negotiation. I would say most bonds are accepted. About 15% of them present some challenges, and we just got to talk that through. And sometimes you just got to make a stand and say, no, hold on, that's just not possible. You're asking for, that's just unreasonable. And it's down to relationship, it's down to negotiation. So it's another reason really to get us involved and get the right underwriters involved. As I say, there's no additional cost in us being involved. And certainly we can provide advice around that. As I say, it's all that's our bread and butter. That's what we deal with. So okay. I would say yes, there are issues, but they're usually ironed out.
Great. Okay, somebody's asking a question. If they're insured currently with another company, can Willis Towers Watson still provide bond terms?
Oh yeah, 100%. I mean, I've got clients who like to deal direct with an underwriter. They've been dealing with them for years. I'm not going to set that, but look, I can cover the rest of the market. I can also, hopefully over time, encourage them to also appoint me on that one because it's of no extra cost. And it saves time for everybody. But in answer to the question, absolutely. North, south, east, west. I'm currently negotiating a bond for a client in the States. So we're a global entity. We don't. There's no boundaries from our point of view, and there's no issues around us. So I'd certainly be happy to discuss that with the client involved.
Super. Okay, but another question then. 10% bond value seems to be the norm, but sometimes we see 12.5 or even 20.
Yeah.
Have you experience of a lesser bond value, say 5%?
No, not really.
Impact
No.
that would have on the premium cost?
Yeah, no, I see that question. No, 5% hasn't come up really. I mean, sometimes you might get, what happens is they usually go with 10% and then reduce to 5% for the maintenance period, the 450 days or whatever it is, 6 months. So the bond value goes down, which reduces the cost of the bond. But in general, I'm not saying 5%. In answer to the second part of the question, yes, you could procure a bond value at 5%. If you're not getting it at 10, there's probably good reason for that. The underwriter would probably say, well, I'm not doing it at 5 either. It really depends on the individual circumstances. Again, if you're dealing direct on bonding, you're just going to have to talk to that underwriter. I think you're better off. And I would say this, I know, but it's true. We can certainly give you a better chance of getting a bond. I'm not saying we can do it every single time, but in most cases we do. So look, yes, in answer to the question again, usually 10, I'm seeing 12.5%. I'm not seeing 20%. I'm not seeing 15%. Push back on that. It's not necessary. The value of the bond is really, the payout on the bond is there for one reason. It's to provide money to the employer to bring in another contractor. And the reason, and that does cost money. So they go back to the tender process, who was second, who was third, but that delays things. That needs to be done. And if a surety is involved as opposed to a bank, the surety has experience with other contractors and will get a contractor in and will negotiate with them and reduce the cost of that to a minimum. So they may not pay out 10%, they may only pay out 3%. So that's another good reason to deal with a surety rather than a bank.
Thanks for that, Andy. Trevor, just one thing I was going to ask, as a general impact on insurance, Grenfell, is that having a ripple through the insurance markets? It's much less of an issue in terms of the types of project we see here in the north, but it's bound to have had an effect generally, I imagine.
Yeah, Grenfell had an impact on professional indemnity in particular, and that's where we now have the fire safety restrictions on professional indemnity policies. So back 2+ years ago, things began to get difficult for contractors who were involved in high-rise, being 16 meters plus, and panelled type structures. That then has now filtered through to affect not only contractors, but also the professionals in the construction industry, surveyors, architects, and so on, who have had shockwaves as far as their PI renewal is concerned. So yes, it has had an effect, absolutely.
I'm very conscious of the time and everybody's time for attending this morning. So I'm just going to ask you, Trevor, if you want to wrap up, what would be the key takeaway from Willis Towers Watson today to members listening?
Okay, well, I think it has come through both from myself and from Andy that the whole idea of being prepared well in advance of the date that you need to affect the insurance or affect the bond for that matter. So you need to be thinking well out and give a good lead-in time for underwriters. So really act early as possible, and for your insurance general program, think in terms of 90 days at least. Be prepared to produce good quality, detailed information. You need to sell yourself. That's what you need to do, and with the help of your broker, sell yourself to the underwriters in order to get the best terms. And you're looking then to your broker to do the marketing on your behalf. And again, they need to have that space to go to the market and deal with additional queries in order to bring to the table at the best terms at the best price.
Fantastic. Trevor, Andy, thank you both very much. I'm sure you'll be happy to help anybody after the event. I'll be sharing your contact details with attendees. But thank you both very much. Very detailed, very helpful presentations. Thanks to Willis Towers Watson as ever for being our insurance patrons. And thanks everybody for attending this webinar. I hope you have a good rest of your day. Thank you.
Very much.
Thank you. Bye-bye.
Bye-bye.